Hello everybody and welcome to Today in Markets. Nexperia. This might be the first time you're listening to this company's name, but this company manufactures one boring component and China and the Netherlands have been fighting over it. And now a fight over a boring component is now threatening production lines around the world. And in the second story, India-US are near to closing the deal. Big tariff cuts are in the picture for Indian exports, but will India really shift from buying Russian oil? Hi, this is your host C.A. Suhani Kataria, and let's begin. Think of your car like a small city. There are big famous buildings everybody talks about. The engine, the battery, the fancy screens. But that city only works because of thousands of tiny silent workers who keep the light on, direct traffic, and stop fires before they start. Those tiny workers are the simple chips Nexperia makes. Diodes, transistors, MOS FETs, little logic gates. They're cheap, they're everywhere, and they quietly keep everything running. Now, imagine one morning those workers can't show up. Even if 99% of the parts are ready, the city cannot open. That is what happens in a car factory. If a handful of small chips are missing, the entire car stops on the assembly line. You cannot just swap them overnight because car part needs strict safety approvals. If you change the part or even the factory that makes it, you must test again. And that takes your time, and not in days but often months. Here is where the drama starts. Nexperia is based in the Netherlands, but a lot of its chips are finished in China. The Dutch government stepped in and took control of the company, saying it was a matter of security and good governance. China then blocked exports of some Nexperia parts from its factories. Suddenly, chips that usually flow smoothly from fab to factory got stuck in the middle. Inside the company, one side is China and the other side is in Europe, seem to be pulling in different directions. For customers, that sounds like we cannot promise you when your chips will arrive. Now, here are the few possible outcomes of this situation. In the best case, China allows certain exports again and the Netherlands limits its action to oversight. So supply gradually improves. In a middle scenario, Nexperia shifts some assembly and testing out of China, but this move takes months and customers will need to reapprove the parts. In the worst case, the split continues, supply stays unreliable, and auto and industrial companies face production delays. Now, can the other manufacturers step in? Yes, there are other solid chip makers, but switching is not like changing toothpaste. You have to test, certify, and make sure that the parts will behave perfectly in heat, vibration, and real roads for years. And those other factories are already busy. So even with the best intentions, relief takes time. Now, what happens next depends on how the two governments in the company move. In the best case, some exports are allowed again and the pipeline starts flowing, slowly but surely. In the middle scenario, Nexperia shifts some of its out of work, but customers still need to reapprove parts, which stretches the timeline. And in the worst case, the split drags on and more factories face stop-start schedules. But for India, this is both a warning and a window. It is a warning because our automakers and electronic companies use the same global supply. If the pipe clogs, we feel it too. It is a window because it shows why building assembly and test capacity here matters. It is not glamorous like AI chips, but it is the plumbing that keeps the whole house working. If you build that plumbing at home, the next shock hurts less. Here is the idea in one line. The chip war is not only about supercomputers and AI. Sometimes it is just about 5 rupee diode that decides whether your headlights flicker or your car ships at all. And for the second news, the United States and India are close to finalizing a small trade deal that focuses on tariff, energy imports, and market access for farm products. The announcement may be made at the Asian Summit later this month, but both leaders have not officially confirmed their participation. The broad framework appears ready, but sensitive areas like agriculture and energy still need political approval. A major part of the deal is a cut in US tariffs on Indian goods. The current overall tariff burden reportedly rose to about 50% after an extra 25% duty that was added in August as a penalty for India's Russian oil purchase. The proposed deal would reduce this tariff to about 15 to 16%. This reduction would make Indian exports more competitive in the US, especially in textiles, engineering goods, pharmaceuticals, gems and jewelry, and seafood. But energy is the most sensitive piece. The US wants India to gradually reduce its purchases of Russian crude oil. India became a large buyer of discounted Russian oil after 2022 because it helped keep domestic fuel prices in check. Today, Russia accounts for roughly one-third of India's crude oil imports, or about 1.6 million barrels per day in the first half of 2025. India has signed that it is open to diversifying oil supplies, including buying more from the US, but only if prices remain viable and energy security is not threatened. The deal also discusses market access for agriculture and energy products. India is considering a higher import quota for non-GM corn from the US. This would help the poultry feed, dairy, and ethanol industries, but domestic farmers worry about downward pressure on prices. India is also discussing allowing non-GM soybean imports for feed and food. They could reduce cost for livestock producers, but it may hurt local processors and discourage soybean cultivation if not managed carefully. The US wants lower tariff for premium dairy products like cheese, but that remains politically sensitive in India, so any opening would likely be small and controlled. India is also weighing ethanol imports from the US, which could support its blending targets and provide the US with an energy trade win. And the main part is this. India wants a built-in review clause, so both sides can revisit tariffs and quotas periodically. This gives flexibility if energy prices change, if farm policies shift, or if supply chains needs adjustment. It can also make sense for a narrow issue-based agreement rather than a full free trade agreement. Both countries have strong reasons to move ahead. The US wants to build resilient supply chains outside China, and India offers scale and capacity. India wants tariff relief so exporters can regain lost orders, and it wants to protect affordable energy for its citizens. Two-way trade has already reached a record level, and a lower tariff regime could lift it further. If the deal is signed and tariffs drop to about 15 to 16%, labor-intensive sectors like textile, footwear, home goods, and some engineering products would benefit quickly. Small and medium exporters would see a better margin and more stable orders. If India reduces Russian oil purchases without equally discounted alternatives, refiners may face low margins and the oil import bill could rise. That risk can be managed if India secures competitive pricing from other suppliers and uses smart hedging. If India opens limited quotas for corn, soybean, and possibly dairy and ethanol, feed and dairy companies may benefit from lower input costs. But domestic farmers and processors will likely ask for safeguards like quotas, standards, and phased entry. The most important signals to watch are four things. First, look for a formal US notice that rolls back the extra 25% tariff layer and enlists which product gets relieved and when. Secondly, look for an Indian statement that talks about diversifying oil suppliers and any energy agreement that mentions volumes or price windows. Third, watch for Indian trade notifications that set quotas and standards for corn, soybean, dairy, and ethanol. And lastly, check whether the final text includes a clear review clause with timelines and triggers. In short, the deal trades tariff relief for a gradual shift in India's oil sourcing and a measured opening in a few farm and energy lines. It aims to protect India's energy security, support Indian exporters, and give the US market access and supply chain stability. Now let's get to the news flash section, where we can see global steel production falls 1.6% in September as the China output drops 4.6%. Global crude steel production declined 1.6% to 141.8 million tons in September 25 compared to the same period last year, according to the World Steel. China, the world's biggest steel producer, saw its output drop 4.6% to 73.5 million tons during the same period. The decline is contributed significantly to the overall global decrease in the steel manufacturing. Now, let's go to the Insights tab and look at today's top gainers and losers, where let's look at the top gainers for today, where we can see that Infosys is up by 3.81%, followed by HCL Tech, which is up by 2.55%, TCS is up by 2.21%, Axis Bank is up by 1.74%, and ONGC is up by 1.69%. These have been the top gainers for today. If we talk about top losers, then Eternal is down by 2.88%. Bharti Airtel is down by 1.74%. Ultratech Cement is down by 1.6%. Reliance is down by 1.15%. And ICICI Bank is down by 1.32%. If we talk about the FIDI data, as of 21st October 2025, FI bought in net cash of 96 crores, whereas DIR sold of 607 crores. If we talk about today's top deliveries, today's 5 top deliveries are Axis Bank, HCL Tech, Coal India, ITC, and Bharat Electronics, which range from 69% to 65%. Now let's go on Dhan charts and analyze Nifty 50 for today. So as we can see, today we did a gap up opening of almost 200 points due to the news that we saw earlier today that Trump is going to reduce the tariff rates from 50% to 15%. And also the Diwali festival was a really good one in terms of sales and everything. But we eventually saw that during the day, market covered the gap and closed at the low of today. So if you look at the stats, Nifty opened around 26,000, made a high of 26,100 and closed around 25,891. If you look at 50 EMA and 20 EMA, Nifty is trading well above that, and its RSI has also risen to 72. We don't know where the Nifty will go in the future days, but that's something that we can look forward to. Today was Sensex expiry, and Sensex is up by 130 points today. Sensex opened around 85,154, made a high of 85,290 and closed around 84,556. It is also above its 20 EMA and 50 EMA, and its RSI is also at 73. If you look at the today's top gainers and indices, we see Nifty IT is up by 2.21%, followed by private banks, which is up by 0.49%, and CPSE is up by 0.44%. If you look at the top losers, Nifty Commodity is down by 0.39%, Midcap is down by 0.21%, and Pharma is down by 0.15%. That's it for today. I'll see you tomorrow. So, what do you think? Will this deal be beneficial for India, or will we lose on more? Tell us in the comments below. Till then, like, share and subscribe, and stay curious and stay updated.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.